And for the last 25 years now, LCP has been acting for clients who recognise the investment opportunity in prime central London residential, but want professional help and advice to maximise their returns. Recently, however, I've been quite taken aback by just how many of our clients have been given incorrect advice on their property holdings when it comes to the new tax legislation that has been brought in over the last couple of years. I hope this blog will help dispel some of the popular misconceptions. You may recall that back in 2012, a new annual tax on so-called envelope dwellings was announced in the budget, otherwise known as ATID. Originally, this was going to apply to all residential properties held in corporate structures. However, many of our landlords and the property companies that we advise hold properties in this way for sound commercial reasons. In the end, the private rented sector was excluded from the annual tax. The PRS was also exempted from the associated ATID capital gains tax and the higher rate ATID SDLT, which was set at 15%. Then, on 3rd of December 2014, a new way of calculating stamp duty land tax is announced. The new system is known as progressive and replaced the old slab rate. Broadly speaking, this means that any property bought for more than 1.125 million pays more tax, with significant increases at the top end of the market. Whilst these increases are likely to be assimilated into the cost of entering the market, the good news for investors in the PRS is that they are on the side of the winners. Rental investors should be focusing on properties below £1 million as they rent with the best yields and get the most consistent capital appreciation. The sub £1 million target price point also puts rental investors in good stead if the much talked about mansion tax ever sees the light of day. The threshold banded about is 2 million or perhaps 3 million, putting small rental units far from the tax collector's reach. But the most current topic at the moment is the new capital gains tax measures for all non-resident investors in UK residential real estate, which came into force just this 6th of April. This means that all non-residents, whether trusts, companies or individuals, will now be subject to between 18% and 28% tax on the profits they make on directly held investment assets, bringing them in line with UK resident investors. And herein lies the rub. What has been an attractive anomaly for non-residents no longer exists. However, you may have noted my phrase, directly held investment assets, because HM Revenue and Customs has exempted property funds like ours, which have genuine diversity of ownership, from the non-resident CGT. Investors into our fourth listed property company, London Central Apartments 2, which incidentally will be closing to subscriptions in the next couple of weeks, will directly benefit from this tax exemption. It is also designed to provide non-residents investing in prime central London residential property with other attractive tax breaks. So how do we manage that? Well, because it targets the private rented sector, none of those ATID taxes apply. And by buying below £1 million, it also benefits from reduced SDLT costs. Through moderate gearing, it is able to set off the rental income against the mortgage and running costs, so there is no income tax. For UK non-DOMs, the assets you hold as shares in a Jersey company, which are outside the scope of UK inheritance tax. And of course for non-residents, the profits you make from LCA2 will not be subject to capital gains tax in the UK. Apart from all this, you can be flexible as to how much you invest, starting from just £85,000 for all investors and £25,000 for certain eligible investors, whilst getting the diversification benefits of a portfolio of lots of individual flats rather than being tied into just one. You benefit from buying power, from picking up deals before they reach the open market, as well as professional management, pre-arranged bank finance, and LCP's exemplary track record. LCA2 capitalises on the growth potential within the market, which has averaged more than 10% per annum over the short, medium and long term. And it is this that makes the exemption from the new CGT legislation all the more persuasive when weighing up a fund investment with going it alone. I would conclude this by saying that LCA2 will not be applicable for everyone, and if you are in any doubt as to its suitability for you, you should consult a qualified advisor. For more information on anything covered here, please feel free to drop me a line via the details below. You can also find further information on LCA2 via the link. I do hope you found the video blog useful and constructive, and we very much look forward to hearing from you with your feedback.